Bismillahirrahmanirrahim. In this lecture, we will discuss some other aspects of inventory and some of the more questions which are related to your chapter number 8. Starting with the question which is related to periodic inventory system and perpetual inventory system. The first question is, and it is problem 8.2 and 8.3. First we will discuss 8.2 and after that 8.3, because the whole data is related to both of this question. So for Speed World Cycle sells high performance motorcycles and motocross racers. One of the Speed World's most popular model is Kazoma 900 dirt bike. During the current year, Speed World purchased 8 of these cycles at following cost. The purchase date is July. The first purchase is on July 1st. 2 units were purchased at the cost of 4,950, and the total cost was 9,900. And July 22nd, they purchased 3 more units that are 5,000 each unit, and the total cost was 15,000. On April 3rd, 3 more units were purchased at a cost of 5,100 per unit, and the total cost was 15,300. The total cost of all these units is 40,200, and after the purchase of April 3rd, the total unit purchase were 8. Oh, okay. Now on July 28, Speed World sold 4 Kazoma 900 dirt bikes to Vince Wilson Racing Team. The remaining 4 bikes remain in inventory at December 30, the end of the Speed World's first fiscal year. Assume that Speed World uses a perpetual inventory system. And what is perpetual inventory system? The perpetual inventory system is the system in which the company make up-to-date changes, and they are making adjustment from time to time, and they are taking data from different time periods, and they update their records consistently, as compared to the periodic inventory system, in which they'll take physical inventory or inventory count after a certain time period. But in this case, they are using perpetual inventory system, and perpetual inventory system is the system in which you make up-to-date records of each purchase and each sold, and whatever the changes are in the inventory. So your instruction is compute the cost of goods sold related to the sale on July 28th. And secondly, the ending inventory of Kazoma 900 dirt bikes at September 30, using the following cost flow assumption. First one is average cost, first one is average cost, second one is FIFO, and the third one is not visible over here, but the third one is LIFO method. Now, starting with the solution of this question, first we will find out the cost of goods sold in ending inventory based upon the average cost method. As in this question, you have to ascertain that they are taking cost of goods sold at July 28 and ending inventory at September 30. And we have one purchase which is after the sale of July 28, that is August 3rd. So when we are finding the average cost for this question, so you have to ascertain that when we were selling these units, if you're selling 4 units, at that point we have only 5 units in hand, and at that time we have the average cost of 24,900. So on the basis of that, we'll find the average cost. As it is a perpetual inventory system, that's why we have to ascertain this thing. So average cost as of July 22nd was 24,900, and there were 5 units at hand. We divided 24,900 by 5, and we get 4,980. This is the average cost. Now, cost of goods sold is based upon this average cost. 4 units were sold at a cost of 4,980, and the total cost is 19,920. Secondly, we have to find the ending inventory. In this case, we have 4 units and on hand at September 30, and this also includes the purchase of April 3rd. Then average unit cost following August 1st purchase. First of all, one unit at July 22nd, average cost of which was 4,980. Three units purchased on August 3rd were 15,300, and the total cost is now 20,280. Divided by 4, we'll get 5,070. This is the average cost of the units at time when we are closing down or we are moving to another period, and this time we are ending inventory is it can be derived from 4 multiplied by 5,070, and the total ending inventory value is 20,280. Secondly, we have to find out find out the cost of goods sold and the ending inventory by using the cost flow assumption FIFO. In this case, cost of goods, when we are finding cost of goods sold, two units, we have taken two units from July 1st purchase at a cost of 4,950, and two units from July 22nd purchase, that is 5,000 per unit. Now the total cost of goods sold is for 4 unit is 19,900. And in case of ending inventory, as we know that we have 4 units at September 30. So first unit from July 22nd purchase, that we have purchased at 5,000 per unit. So 5,000 of that, and 3 units from August 3rd purchase at a cost of 5,100 per unit, and the total cost is 15,300. And the total cost ending inventory value is 20,300 in case of FIFO method. Lastly, we have last in first out method. Cost of goods sold on July 22nd. So we have taken 3 units from the purchase of July 22nd. In this, you should note that we haven't taken August 3rd purchase, because August 3rd purchase is done after the sale of these units. Therefore, in this case, we have taken last unit from July 22nd. So third, 3 units from purchase of July 22nd at a cost of 5,000, and 1 unit from the purchase of July 1st, that is 4,950. The total cost is 19,950. This is cost of goods sold value. In case of ending inventory, we have 4 units in hand and 1 unit from the purchase of July 21st, that is 4,950, and 3 units on the purchase on August 3rd, that is 5,100 per unit. Multiply by 3, we'll get 15,300, and the total ending inventory value is 20,250. Now the second question is, assume that Speedwell uses a periodic inventory system, and the same data, we are using the same data for which we have used for the previous question. Instruction are compute the cost of goods sold related to sale on July 28 and the ending inventory of Kazuma 900 by September 30 using the following cost flow assumption. Average cost, FIFO, LIFO. Show the number of units and unit cost in each cost layer of the ending inventory. You may determine the cost of goods sold by deducting ending inventory from the cost of goods available for sale. If Speed World Cycles uses the LIFO cost, second part is that if Speed World Cycles uses the LIFO cost flow assumption for financial reporting purpose, can it use the FIFO method for income tax purpose? Explain. Now, solving the question, this is the second question. The same as we know that this is the value which we are using in this question is the same which we have used for the previous question, but over here we have to use periodic inventory system rather than perpetual inventory system. And in the periodic inventory system, all the calculation and all the information is recorded and updated and adjusted at the end of the period. That's why we have to first find out the ending inventory at September 30 and cost of goods sold through September 30, because all the things are adjusted at the end of the period, so we'll find it. So in case of average cost, First of all, we have to find we know that the total cost of the of all units are 40,200, and we have 8 units in hand, so we divide 40,200 by 8, so we'll get average cost of 5,025. And at the end of the period we have only 4 units left in our inventory. That's why we multiply 4 units with 5,025, and the total ending inventory is 20,100. In case of cost of goods sold through September, cost of goods sold available for sale is 40,200, and we have deducted the value of ending inventory, that is 20,100. Now the cost of goods sold is 20,100. In case of FIFO method, the ending inventory of 4 units at December 30 is 3 units from the purchase on August 3rd, and the 5,100 was per unit cost, and 1 unit from the purchase of July 22nd, that is 5,000. Oh, now in this case you will have to consider that we are finding the value of ending inventory, and in case of FIFO, FIFO will be used for first in first out is used for cost of goods sold, but as we are finding out the ending inventory, that's why the ending inventory has the latest cost of the latest cost per unit. Therefore we have taken the 3 units from August 3rd purchase and 1 unit from the July 22nd purchase. For first we have 15,300, and for the second 1 unit from the purchase on July 22nd we have 5,000. The total value of ending inventory is 20,300. In case of cost of goods sold, we have cost of goods available for sale, that is 40,200. We deducted the value of ending inventory, that is 20,300. The cost of goods sold now is 19,900. In case of last in first out, that means that we have the ending inventory had the oldest cost. That means because we are transferring the cost of latest units to cost of goods sold, therefore the ending inventory has the most older cost. That means the cost which is being incurred at the start or the earlier stages. So, and the 2 units from the purchase of July 1st, that is 4,950 per unit, and 2 unit that is 9,900. 2 units from the purchase on July 22nd, that is 5,000 per unit. 10,000 is the total cost, and when we add up these costs, we will get the ending inventory value, that is 19,900. Now in case of cost of goods sold, cost of goods available for sale is 40,200. We deducted the value of ending inventory, that is 19,900. Now the total cost of goods sold in case of LIFO method or first out method is 20,300. Now the B part, we have the question. So for that, yes, the income tax regulation influence the inventory method used in financial reporting only when the LIFO method is used for income tax purposes, because when LIFO method is used we have a highest cost, and if company selects the FIFO method for income tax reporting, it is free to choose another method for financial reporting purpose. So that's the main reason. Now starting with the other question, this question is related to periodic costing procedure. Mac 4 Audio uses a periodic inventory system. One of the store's most popular product is a mini dice car stereo system. The inventory quantities purchased and sale of this product for the most recent year are as follows. Inventory July 1st was 10 units which were purchased at a cost of $299. The total cost was $2,990. First purchase was done on May 12th. During this period, 15 units were purchased at a cost of $306, and the total cost was $4,590. Second purchase was July 9th, and 20 units were purchased at a cost of 300 NH per unit. The total cost is 6,160. Third purchase was done at October 4th, and 8 units were purchased on this date at a cost of 315 per unit, and the total cost is 2,520. Then fourth purchase is done at December 18 and 19 units of purchase at a cost of $320 per unit, and the total cost is 6,080. Goods available for sale is 72, and the total cost of all the units is 22,340. Units unsold during the year is 51, and the units and ending inventory, that is on December 31st, is 21. Now, using instructions are that using a periodic costing procedure, compute the cost of December 31st inventory, that is actually ending inventory, and the cost of goods sold for mini disc system during the year under each of the following cost flow assumption: first in, first out, last in, first out, and average cost, and you have to round it to the nearest dollar. Then second reduction is which of the three inventory pricing procedures or methods provide the most realistic balance sheet valuation of inventory in light of the current replacement cost of mini disc units. Does this same method also produce the most realistic measure of income in the light of cost being incurred by Mac 4 Audio to replace the mini disc system when they are sold? So now coming to the solution. In this case, first of all, we have to find out the ending inventory and cost of goods sold. And first of all, we'll use FIFO method. FIFO method, inventory is fourth purchase is because it's a FIFO method. So in ending inventory, we have the most latest units, because when we come to the ending inventory, so LIFO become FIFO. We'll take opposite thing, because we are now considering the ending inventory. In case of cost of goods sold, we will take the oldest units. So in this case, first of all, as we know that we have 21 units in the ending inventory, and in the fourth purchase we have only 19 units. So 19 units we have taken from the fourth purchase, and 2 units we have taken from the third purchase. And in the first and fourth purchase, the per unit cost was 320, and in the third purchase the per unit cost is 315. And the total cost of ending inventory is 6,710. 6,080 from the fourth purchase and 630 from the third purchase, and the total cost is now 6,720. So this is the amount of ending inventory. In the case of cost of goods sold, we will take the cost of goods available for sale, that is 22,340, and deduct ending inventory value, that is 6,710. So now we have cost of goods sold in case of FIFO 15,630. In case of LIFO, first of all, we'll take ending inventory, and in ending inventory we'll take the most latest the most oldest cost, that is because it's a LIFO, and in the LIFO the inventory has the oldest units. That means that the units which we have purchased first. Then beginning inventory, we have 10 units, and which were purchased at a cost of 299 per unit, and first purchase was done on 12th May, that is 11. By considering the value, so first of all, for beginning inventory we have 2,990, and from first purchase, which is of at May 12th, is 3,366. So total ending inventory is 6,356. In case of cost of goods sold, what we'll do is we'll take the cost of goods available for sale, that is 22,340, and deduct the value of ending inventory, that is 6,356 in case of LIFO, and the cost of goods sold is now 15,984. Third one is average cost method. In average cost method, we'll take the average per unit cost. So average per unit cost is determined by dividing the total cost of good available for sale divided by the total units which are available for sale. So in this case, we have 22,340, and the total units in hand is 72. So dividing this, we'll get 310 per unit cost, and the total cost is the total cost is 6,516. So this is the cost of ending inventory, because we have 21 units in the ending inventory. Now, cost of goods weighted, your average cost of 310.28 per unit hai, but we have to take it up to the nearest dollar. So we have 51 units in hand. So multiplying it with 310.28, we'll get 15,824. So this is the total value for cost of goods sold when we are taking average costing method. Now, B question suggests that the FIFO method, by assigning the cost of the most recent purchase to inventory, provides the most realistic balance sheet amount for inventory in terms of replacement cost. Why? Because replacement cost is that it's the latest cost, and whenever you want to take new inventory, so LIFO will provide you, FIFO will provide you the most realistic value. A weakness in the FIFO method, however, is that the cost assigned to the cost of goods sold are relatively old cost because the replacement cost of the unit has been rising throughout the year. The FIFO method tend to understate the cost of the goods sold in terms of costs actually being incurred by MAC 4 to replenish its inventory. The LIFO inventory method assigns the most recent cost to the cost of goods sold and therefore provides a more realistic measure of income in terms of current replacement cost than does the FIFO method does. Thank you.